Hello everyone, Clifford Bennett here with the Property Club sponsored update on the outlook for the Australian economy in the year 2025. Out here on adventure wilderness journeys and safaris, and it's a little bit like that for the Australian economy moving forward. In terms of the property market, it's begun to get a little bit spotty, as I've been saying all year it would. So some suburbs, some areas, some cities are actually down now, and other areas are still very buoyant. I actually think it's going to be the very high end of the market, the luxury homes and apartments, that really begin to feel the pain as we go into 2025, while more residential, usual Australian suburban areas could find their footing and actually make some gains. But as always, please check with your local expertise, the local experts at propertyclub.com.au. The Australian economy, well, we all know it's growing at about 1% at best at the moment, and all of that, or more than that, is government spending. So the private sector in Australia is in a period of contraction. So it's no surprise that corporate profits have fallen sharply for both of the most recent quarters we have data for. Over 6 months falling very significantly indeed. Corporate profits down. Unemployment had a little bit of a bounce. Unemployment dropped to 3.9%. Jobs had a boost. Unemployment dropped to 3.9% on the most recent data. But of course, there's a lot of hiring in the hospitality industry going into the holiday period. So we'll see how that is seasonally adjusted, but we'll see how that pans out going into the new year. In terms of the current account, we're actually running a current account deficit now in Australia, and we used to always run positives. In terms of debt to GDP, government debt to GDP, we're at about 19% in 2019, and all of a sudden we're at 43% of GDP as government debt. So it's more than doubled in the past few years, and that again is a warning sign, as is the GDP data per capita, which has been trending down for a while now, which means that per average person in Australia, life's getting harder. So imagine how much harder it's getting for perhaps half the population, if not a slight majority, because we know the wealth gap has been growing in Australia. And as the wealth gap grows, then the aggregate data that we see, that face sort of that first headline number, say for instance for retail sales, becomes less reliable as an indicator for what's happening with most of the Australian population, most Australian households and families. Because we know that the wealth gap's growing, the very rich and the moderately rich are doing very well, and they're still spending big, which makes the retail sales numbers look good as they spend big on luxury items. But for many Australians, it's already a case of really consumption, complete consumption stall, on discretionary spending especially is plummeting, I would suggest to you, but it's hidden in the aggregate data. So the unemployment number looked good. The RBA is going to use that to say we're right not to be cutting rates, which means that the Australian economy will continue to stumble into 2025 in a parlay state, really. I think we can expect a definite private sector recession in the first half of 2025 for Australia. Perhaps a headline number, GDP number recession, but definitely private sector. I think towards the end of the year, things could pick up a little bit. What's the RBA likely to do? I was the first economist in Australia 2 months ahead of the major banks to forecast the RBA could be cutting rates this year. And we've all had to unwind those forecasts as the RBA has remained resolute on the idea of stability, and only up until the most recent Reserve Bank meeting, the Reserve Bank governor was actually still talking about hiking rates. Now inflation is at 2.8%. Interest rates, the official cash rate's at 4.35%. There's no need for it to be there, because also the RBA's missed the point that it's raising rates is not why inflation is slowing. Inflation is slowing naturally as the post-COVID period where there was basically no competitive pricing pressures at all, and companies, businesses of all sizes, from your coffee shop to your major corporation like Woolworths, Coles, could basically increase their profit margins without losing market share. And that's why we had the big surge in inflation, as well as geopolitical tensions. We didn't have an overheating economy. Well, when we did, the RBA kept rates at near zero. And now when the economy is stumbling, the RBA has been wanting to keep hiking rates. That's why today and this week, the Federal Treasurer has announced a bit of a shake-up of the board at the RBA, appointing 2 new outsiders into the bank. But I think there will be further changes that do take place there. I do think that the current governor will be a one-term governor as per her predecessor, because of underperformance, because of the blunt rejection as much as the governor could, of the reforms that the International Independent Review found the RBA wanting. The OECD report found the RBA in urgent need of major reform due to its poor performance. So we're not talking about ifs and buts here. The RBA has been an underperforming, poor institution for many, many years. In fact, in the middle of the GFC, they raised rates 3 times. So it's not like this is a new recent phenomena with the previous governor. This has been a problem for Australia for the last 15 years at least. And I think going forward, if the Australian economy is going to find its feet, we do need, because there's a huge global restructuring going on, we do need an RBA that knows what it's doing, understands what inflation is today as an animal, a very different animal to what it was even 3-4 years ago, let alone last century. So the RBA's had this idea, raise rates when inflation is high. But you only do that if the high inflation is caused by an overheating economy, and we don't have an overheating economy. So why was the governor talking about might have to raise rates again only 1 or 2 meetings ago? It's not even year 11 economics, really. So these changes by the Federal Treasurer are very welcome indeed. We welcome further significant overhaul, in fact, revolution of the Reserve Bank, if it's ever going to become anywhere near an internationally respected institution, because that it is not at the moment. So, outlook for Australia's GDP next year is around 1.5% for the through year, which is about where it was over the last 12 months, just hanging in there, because I see a recession in the first half of the year. I see massive interest rate cuts, obviously after the fact, behind the curve, poor central banking, but still those rate cuts will happen because of the dire state, unfortunately, of the Australian economy. And remember, this is an underperforming Australian economy, even when you have record levels of, it's century record levels of immigration that's been going on over the last couple of years, hence the housing crisis for many Australians struggling, and hence the upward movement in prices for housing, accommodation in general, and particularly for renters. So those high prices for renters are probably going to moderate now. Property prices are going to be very regional specific processes over the next 1 to 3 to 5 years. They're not going to be a broad macroeconomic response indicator as they normally are, because there's so many different stories happening in the Australian landscape now. You really have to zoom in on each situation. So again, I suggest you propertyclub.com.au. So outlook, Australian economy, economic growth 1.5%. That's optimistic. It's possible it will be flat to 0.5%. That's the risk direction. Private sector is going to have a recession definitely in the first half of the year. The RBA is going to cut interest rates, I would say, to about 2.85% by the end of next year. And that will, with time, with a lag, and this is what the RBA always forgets, takes time for that to filter through the economy to begin to support it again. The other sort of headwind Australia faces is if the US applies significant sanctions against China, China's demand for our goods could again suffer a little bit of a setback. They're still buying from us, but wherever they can, they shop elsewhere because of the diplomatic stoushes we've had with them over the last several years, which started After decades of prime ministers doing their best to build a good relationship with China, Prime Ministers Morrison and Albanese have undone a lot of that goodwill. Can it be rebuilt? Perhaps it can, but it will take a little bit of time. So China will buy what it needs from Australia elsewhere whenever it can, but it will still be buying a lot from Australia. So that's a very good thing. It was Chinese economy doing well, they're managing their economy well during the GFC that stopped Australia from going into recession. Though domestically, with the RBA raising rates 3 times in the middle of the GFC, they sent New South Wales and Victoria, our most populous states, into recession at the time. But that was masked again by the aggregate data. The mystery of aggregate data to hide problems in an economy is quite astounding. The aggregate data was boosted by 16% growth in the export sector due to China continuing to power on and not be caught in the GFC as many forecast. So that boosted our aggregate GDP number. Australia avoided a recession. We patted ourselves on the back, but it wasn't really us that saved the day. Well done, our miners and agricultural sectors, for being world's best practice. They most certainly are, and they've kept Australia going during very challenging times. This time round, there's a bit of a question mark over further growth in those sectors. But right now, I would suggest to you the Australian dollar is going to be vulnerable because of those trade sanctions possibility by the US on China, which has nothing to do with us, but could hurt our trade. The stock market in Australia has been looking very top heavy for quite some time, particularly after the last 2 to 3 weeks as we come to the end of year close. And I'm actually suggesting people to protect their equity portfolios at this point, as I do see the first 3 to 6 months of 2025 as being a risk period for Australian equity markets, perhaps US markets as well. You will see in the headlines, oh, the NASDAQ did this, the US 500 did this, but the Dow Jones has been falling terribly now for over 2 weeks. So has the Russell 2000 index. So there are real problems hidden away from the mainstream media headlines, which always want you to invest and are always spun that way. So grain of salt with anything you see in the Wall Street media sort of headlines. There are a lot of problems with the US equity market as well, but the Australian market looks a little bit dire given that we could be going into recession. Property markets could see an influx of capital if people exit the equity market in the first 1 to 2 quarters of 2025, but only to very specific regions again. I do like areas of high immigration. I just think that tremendous demand there in those regions of various cities around Australia where there's a high immigration influx, they're going to remain well supported and probably gain very nicely during 2025, even as the economy suffers a little bit of a setback. But then you will have Reserve Bank too late, coming to the party too late, but nevertheless cutting rates aggressively, which it will boost the property market. So in some areas of Australia in the property market, we're going to see a little bit of a dip, a lull. In other areas, that'll just keep powering on. But towards the second half of next year, fourth quarter especially, we should see stability and a beginning of another up curve for the property market, I would think. Hope this helps. cliffordbennett.com.au, and don't forget to visit propertyclub.com.au for very specific, helpful information. Thanks very much.